Hello, Accounting 101 students. In this video, we are going to go over Chapter 5, question number 4. And in this problem, we have two companies, and we're going to be recording the transactions for each of these companies. So we're going to go ahead and get started by reading through the information in this problem. On June 10th, Columber Company purchased 7,300 of merchandise from Oriel Company. So the first thing that you want to do in a problem like this is identify who is the buyer and who is the seller. And that's going to help you with this problem in terms of knowing which accounts you're going to debit and credit and who are the two parties in the that you're having the transactions with. So we have Columber Company. They're making a purchase. So in this problem, they're going to be the buyer. So they're going to be the purchaser. They're going to go ahead and buy the items. And then we have Oriel Company. And Oriel Company is selling the merchandise. And what you're going to notice is that there's some terms associated with this purchase. So with this purchase, Oriel Company is saying that when you purchase that merchandise, you have 30 days to pay it, but if you pay within 10 days, you're going to get a 3% discount. So the way how you read this is 3% if paid within 10 days, so 3-10, 3% if paid within 10 days, or, so the comma means or, the net amount, so the amount that is due, has to be paid within 30 days. So the first thing that we need to do on June 10th is record that purchase of the merchandise. So to record the purchase, we're just going to record on Columber Company's books the inventory as a debit because they're receiving inventory, and a credit to accounts payable. And one thing I want to highlight in this problem is that both companies are going to use a perpetual inventory system, which means that they have an actual inventory system to keep track of all of the amounts that are going in and out of their inventory. So for our inventory account, we're going to start off with a debit to inventory for the purchase on June 10th of $7,300. And for this particular chapter, it is very helpful to draw out the T accounts. That way you can keep track of all the different things that are happening. On June 10th, we had that purchase. And you don't need to do anything with the terms. You only need to look at it when you actually make the payment. The next part of this is Columber Company. So the buyer is going to pay the freight cost of $360 on June 11th. So what this means is that they're going to be paying for the freight. So they should be including that as part of their cost of inventory. It's part of their cost to acquire that inventory that they have purchased. So we're going to record that as part of the inventory, $360 on the debit side. Next, they are looking at their merchandise and they're realizing, you know what, we're not happy with the quality, or we have $500 of merchandise that is damaged or not usable. So we're going to go ahead and return this back to Oriel Company for credit. So one of the things that you also want to keep track of is what are the amounts that I owe? What are the amounts that are due? So it's also helpful to have an accounts payable T account set up. So that way you can keep track of all the amounts that are owed to your vendors and suppliers. So in this example, we have a credit of $7,300 when we made that purchase on June 10th. So we're going to go ahead and include that amount. And right now, on June 12th, we're going to return $500. So if we're going to make a return, that means that we don't have this merchandise anymore. So on your inventory, you're going to record a credit of $500 for that return on June 12th. And also on the accounts payable, you're also going to record a $500 debit for that return. Because if you're returning something, you don't want to pay for it. Lastly, on June 19th, Columber Company is going to pay Oriel Company in full, less that purchase discount. So remember, in the first transaction, we became informed that there was a 3% discount. I know that the time difference between June 10th and June 19th is within 10 days, so they get to go ahead and take advantage of this discount. So I'm going to go ahead and scroll down a little bit so that way you can see this part of the problem. All right. So the first thing that you want to do is note, well, how much is owed? So on accounts payable, we can see that we have $7,300 minus $500. So what do we need to do to make this go down to zero? Okay. So in order for your accounts payable to go down to zero, you would need to record a debit of $6,800 for making that payment. And once you have made the payment, you want to clear out your accounts payable to a $0 balance once you make that payment. So this is going to be our transaction on June 19th for the payment. But of course, we're not going to pay the full $6,800. The reason why we're not going to pay the full $6,800 is because we want to take advantage of that discount. That's the reason why we made that payment on that particular date rather than making the payment later. So to calculate your discount, you're going to take the amount that is owed. So in this problem, that's $6,800 times the 3% discount. So that's how you're going to get to $204. And remember, your discount has to be based on how much you owe at that point in time. So you don't compute it on the full $7,300 because you returned $500. So your accounts payable was only $6,800. So you're going to compute your discount based on the amount that you owe. And once you compute your discount, that's going to reduce your inventory balance. So that's the reason why we report that as a credit to inventory, because you actually didn't pay that full $6,800 for that inventory. You paid less for it. So you need to reduce that from your inventory account. And your cash is going to be for the difference. It's going to be $6,800, the amount that you owe, minus the discount, and that will be the amount that is going to be reduced from your cash account. All right. So the next part of this problem is we're going to record the journal entries, but this time we're going to be looking at it from the point of view of the seller. So now we're going to record our journal entries for Oriel Company. And the main things that are a little bit different is that the merchandise purchased, that only cost Oriel Company $2,400, and the goods returned cost Oriel Company $210. So the very first thing that you want to record is the sale. So when a company makes a sale, there's two parts of the journal entry. So I'm going to go ahead and draw a line so that way we know that we are now working on another company. So when Oriel Company made the sale to their customer, they're going to impact their accounts receivable and their sales revenue account. They're going to be impacting both of these accounts. So I'm going to set these up. Accounts receivable is going to be recording a debit for the amount of the sale. So you can see this is for the same $7,300 that corresponds with the accounts payable that we had on Cullenberg Company's books. And we're also going to be recording sales revenue. So our sales revenue is going to be a credit for the same $7,300. When we record the revenue, because we have a merchandising company and we use a perpetual inventory system, we also need to reduce our inventory. So in our inventory account, we had an amount. And I don't know what that amount is, so I'll just put it X. But when we sell our inventory, we need to reduce our inventory by the amount of the cost. And we need to also record our cost of goods sold expense as a debit. If our customer is paying for freight, there's no entry. Then we have our return. So a company is going to keep track of their sales returns and allowance in a separate account, so that way they know how much of their sales actually get returned by the customer. So we're going to have our sales return and allowance account. So this is going to be a contra revenue account. So when a customer returns an amount, it's going to be recorded on the debit side, and the accounts receivable is going to have a credit because, of course, the customer is not going to pay for something if they returned it. In addition, your inventory comes back, so that will be a debit, and you also need to reduce out your cost of goods sold for the debit. The last part of this transaction is the payment received from the customer. So the amount that the customer is going to pay us will be based on the accounts receivable balance at that time. So our accounts receivable balance at that time was $6,800. So now we're going to receive that $6,800 payment, and that's going to be recorded on the credit side. The customer took advantage of the sales discount. So similar to before, we're going to take the amount that the customer owes us times the 3% discount that we have offered, and the amount of the discount is $204. And the amount of the accounts receivable was the amount of the sale minus the return, and that's the reason why we have $6,800 for our accounts receivable. The cash that we receive is just going to be the dollar difference. So our dollar difference is going to be $6,800 minus $204 for that discount. And we're going to have a debit to cash because we're receiving money from our customer. One last account I want to include here is our sales discount account. And this is going to be a contra revenue account because the full amount of our sale was not the $7,300 minus the sales return. We also offered a discount, so that reduces our amount of revenue. So I need to record that as a debit. And what we're going to be reporting in our net sales on the income statement is going to be our sales revenue minus our sales returns or allowances minus our sales discount.